The Federal Reserve's dramatic rate hike campaign caused massive losses in bond portfolios, but also created the best opportunities in fixed income we've seen in more than a decade. My guest manages the largest pool of fixed income assets in the world and is Morningstar's outstanding portfolio manager of 2023. BlackRock Global Fixed Income CIO Rick Rieder joins me now. Thank you, Rick. You want to be an outstanding portfolio manager if you're going to run that much money.
It's a lot of hard work. I will say it's been an incredible period in rates.
Yeah, exactly. So since the last time you've come on the show, things have proceeded pretty much in the direction you said they would. But update us. What's your view on the economy? Did we dodge a recession?
So thus far, I think the economy, U.S. economy, is the most resilient, adaptive, reflexive economy in the world. It's incredible how it adjusts. It's a service-oriented economy. It's different than 20, 30 years ago. And I think the economy is doing better than I think people anticipated. The one thing I will say today, though, maybe slowing a bit. But listen, I think people have underestimated how strong this economy can be.
You call it the polyurethane economy, and you've also noted that the absolute numbers of jobs created are phenomenal. I'll go into that a little bit.
So I call it polyurethane because think about how polyurethane bends and adjusts and is reflexive. And you take some shots at the U.S. economy. Interest rates up 500 basis points. Local banks, regional banks having stress. And then the economy is able to adjust to it. And then inflation comes down organically alongside it. So I think that is impressive. The other thing is you think about since May of 20, U.S. economy's hired 26 million people. That is literally like the size of Australia. Every man, woman, and child in Australia. Pretty incredible. What's happened today, though, is we've exhausted. There were so many job openings. That's starting to, because we filled so many of them, particularly in places like healthcare, education, leisure, hospitality, restaurants, hotels, et cetera. So my sense is we fulfilled a lot of those jobs. So my sense is you'll see some slack in the labor force, the wage pressure, the accelerated wage pressure, not without some spots of labor negotiation. But my sense is that will allay itself somewhat over the coming weeks and months.
Also with rate hikes, so you see an immediate effect as it spooks the market. But in the real economy, it takes a while to feel the impact. I talked to guys who work with distressed companies. They're still borrowing money at that ultra cheap rate that they got a couple of years ago. These guys say when that rolls over, they can't afford to pay their debt service.
It's exactly right. Roll-off takes some time. By the way, think about the mortgage market. You think about people locked in. You had rates at historic lows. People locked in 3%, 3.5%.
I'm not moving.
Right. And so, by the way, that's why you think about housing activity is so low is you can't leave your house because you've locked in a mortgage. But what happens over time, people move, get relocated. As you said, so in the loan market, people have to roll over that financing. So you're starting to see that impact. Local banks were funding themselves at levels much higher than in many cases they're earning assets. So it takes a bit of time to work its way through the systems. Part of why shelter, one of the big components of inflation has been higher shelter. That we're certain that is going to come down, that cost is going to come down alongside of it, but it takes time, like you say.
What else do you worry about? What keeps you up at night?
Listen, there's a lot of things in geopolitics that give me some concern. You look at the growth slowdown in Europe and China, and those certainly impact the U.S. And I think the central banks need to stop in terms of the hiking of rates because it's having a real impact, particularly on lower income. The lower income strata, you see that in retail sales in a significant way. You see that in credit card balances growing. I think the central banks need to pull back. We've done an awful lot. Inflation is coming down. Growth is slowing. And so that to me is as long as the central banks stop, say you get one more hike in, maybe. But I think that's a big one.
All right. So whenever we paint this picture, then I like to ask you, where do you see investment opportunities? I suspect if we look in the new portfolio that you're running, the BlackRock Flexible Income Fund, we're going to see what you like.
So BINC is our new ETF that we're pretty excited about, and part of why we launched it and part of why we're so excited about it. You can create yield today. You think about, we've been 30 years, rates coming down, people went through this period of zero interest rates. Now, you can build a portfolio with a 7% yield to it and not take a lot of risk. Think about front-end treasury bills get you 5.5. You can use quality assets like agency mortgages, investment-grade credit. By the way, you don't take a lot of interest rate risk. You can stay in the short end to the belly of the yield curve, sort of out to the 5-year point. It's a pretty historic point in time. You don't have to take a lot of risk, and you can get a lot of yield. Think about for years, rates were at zero. You had to buy high yield, you had to buy emerging markets to get 3, 4, 5%. Now you can build a 7 in a really stable way. Not to say there's not, you don't move around somewhat, But that's a pretty, I mean, we haven't seen that. I've been doing this a long, long time. We haven't seen that in decades.
And we've got to go, but I see a lot of emerging market in that portfolio as well. You feel safe there?
So parts of the emerging markets. Okay. I would say you never feel safe in emerging markets. Mexico, Brazil, in a very different economic paradigm. Inflation's coming down. They're cutting interest rates there. Those places I feel good about. We don't own a lot of emerging markets in some of the speculative areas. But listen, you can build a lot of quality in your portfolio and then take a little bit of emerging market high yield risk and keep the yield at an attractive level.
All right, Rick, thanks so much for sharing your wisdom. Thanks for coming by.
Thanks for having me.